In the last 100 years, this has happened only 4 times. And every single time, the world changed. It's happening right now. I need to be very clear with you. I'm not talking about a crash. I'm not talking about a recession warning. What just happened is actually rarer and more significant than either of those things. The S&P 500 just triggered what analysts call a breadth thrust, a signal so powerful, so statistically rare, that when it appeared in 1982, what followed was the greatest bull run in American history. When it appeared in 2009, the market tripled in value over the next 10 years. But before I show you all 4 historical moments, and what happened after each one, I need to show you something that almost nobody is talking about, because this time, there's a twist. Okay, so what exactly is a breadth thrust, and why should anyone care? Imagine you're watching a marathon. One runner sprinting ahead doesn't mean the whole race changed. But when 90% of all runners suddenly accelerate at the same time, that's a breadth thrust. That's the entire market, not just tech, not just AI stocks, moving upward together with overwhelming force. Specifically, the indicator was developed by analyst Marty Zweig. When more than 61.5% of all NYSE stocks move from oversold to overbought within just 10 trading days, that's the signal. Here's the insane part. This happened only 4 times since 1950. We're now living through the 5th. Let's walk through each of the 4 times this happened, because the pattern is genuinely eerie. Moment 1, 1970. The market had just crashed more than 35%. Vietnam, political crisis, economic fear. Nobody wanted to be in stocks. And then it fired. Within 24 months, the Dow gained over 66%. The people who ran away? They missed it all. Moment 2, 1982. Inflation at 13%. Interest rates at 20%. Paul Volcker was basically strangling the economy. The news was catastrophic. And then, the breadth thrust fired. What came next was 18 years of nearly uninterrupted growth, the longest bull market in recorded history at that point. Moment 3, 1975. Post-Watergate, post-oil crisis. The S&P 500 had lost nearly half its value. The signal fired in January. By December of that same year, the market was up 37%. Moment 4, 2009. I think you know this one. Post-financial crisis. Banks collapsing, unemployment near 10%. The signal fired in the rubble. And then the market went on a decade-long tear, the longest bull run in American history. The S&P tripled. So here's what I haven't told you yet. And this is the part that changes everything when you understand it. The signal doesn't just tell you that the market will go up. It tells you something very specific about timing. Stay with me. Here's what the breadth thrust actually reveals. And most YouTube channels are glossing right over this. Every single time this signal fired, the market was already up strongly before most people noticed. That's the nature of breadth thrusts. They don't appear at the very bottom. They appear when the market has already begun recovering. And the question the signal answers is this. Is this recovery real, or is it a dead cat bounce? When more than 61.5% of stocks participate in the rally, it is real. It has never produced a false signal in modern market history. Never. But here's where it gets complicated. Because right now in 2025, there are 3 things happening simultaneously that have never overlapped with this signal before. And one of them is a serious warning. I'll break down all 3 right after this. All right, let's break down the 3 factors that make this breadth thrust different from every previous one. Factor 1, elevated interest rates. In every prior breadth thrust, rates were either falling or had already been cut. Right now, we still have rates near 20-year highs. That's a friction point. But, and this matters, it didn't stop the signal from firing. Demand was strong enough to punch through. Factor 2, AI-driven concentration. The first four signals happened in a more diversified market. Today, the top 10 stocks in the S&P represent nearly 35% of the entire index. A true breadth thrust cutting through that concentration is actually more statistically significant than any of the previous four. Factor 3. The warning: geopolitical fragmentation, trade wars, supply chain rewiring, dollar hegemony under pressure. This is the wild card that didn't exist in prior signals. It doesn't invalidate the signal, but it does mean anyone acting on it needs a much wider risk margin than 1982 or 2009 investors needed. And this brings me to the most important question of the whole video. What should you actually do with this information? I have a framework, and it has nothing to do with buying individual stocks. This is not financial advice. This is pattern recognition. And pattern recognition is something every investor can legally and ethically use. Here's the framework I'd use to think about this signal. Step 1. Don't chase individual stocks. Breadth thrusts are broad market signals. They don't tell you that Nvidia wins or that Tesla wins. They tell you the market as a whole is likely entering an expansionary phase. The cleanest expression of this signal is broad index exposure. Step 2. Think in time horizons. The average gain after a breadth thrust in the following 12 months is approximately 24%. But the ride is rarely smooth. Pullbacks of 10 to 15% are completely normal inside a post-breadth thrust environment. If you can't hold through a 15% dip, this signal means nothing to you. Step 3. Respect the wild card. The geopolitical factor I mentioned means keeping more dry powder than prior cycles. The investors who won biggest after 1982 and 2009 weren't the ones who went all in on day one. They were the ones who stayed consistently invested over years. The boring answer is the right answer. Always is. Let's make sure this sticks. The breadth thrust fired. It's happened 4 times since 1950. Every single time, the broad market was significantly higher, 12 to 24 months later. 0 exceptions. This time is different in 3 ways: elevated rates, extreme concentration, geopolitical risk. But the signal still fired, and historically, when it fires, it wins. What you do with this is up to you. What I'll tell you is this: every single time this happened, the biggest financial regret wasn't buying too much. It was not paying attention at all. Now, I've been holding back one more piece of data. It's the most specific piece. It concerns timing windows. And it could be the most actionable thing in this entire video. It's in the next video. Link is on screen right now. If this was useful, and I hope it was, hit subscribe. Not because algorithms need feeding, but because the next signal I'm tracking is already forming. And if you're not here when it fires, you'll find out about it 6 months too late. Like the video, if the breadth thrust impressed you. Drop a comment telling me which of the 4 historical moments surprised you most. I read every single one. See you in the next one.